Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I'm one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. On this show, we talk all things financial markets, anything that's in the news, finance related, stocks, anything we're finding interesting. And we've got plenty to talk about this week because there were a lot of earnings reports, a lot of news. Netflix is getting into podcasting. I'll say right now, Netflix, if you want to send us a check, we are very available. We've got Zillow earnings, which a little foreshadowing here. I hated them. I'm buying Google. So that's I guess the big news for me this week. And then Brett's going to be talking through the Philip Morris earnings. We're going to talk a little bit of Crocs, which some people seem to really love both as a consumer and on the investing side. So we'll talk about that. And then really, I think the biggest topic this week is going to be capital expenditures. We got a lot of news last week, so we're going to get into all of that. But I guess I should introduce Brett here. Brett, how are you?
I'm doing well, Ryan. I'm on vacation, I guess, work vacation in the great country of Mexico. So the background here is not as ideal as usual. Hopefully the live stream works here, but getting a little anecdotal evidence, helping out some of our airport operators in this great country, get some better traffic. And going to talk, I guess, little bubble watch. Or you got a question about a little boots on the ground?
Boots on the ground research going. I need you to check out a Domino's there and tell me whether I'll say is worth it.
Well, we had someone go to Starbucks, so I guess that's helping them. There's not many Domino's where I am for some reason. I don't know why, but there's Starbucks, Pizza Hut. Look, they like the American brands, but there's probably some room to grow. They're not as popular as in the United States.
Yeah. Hey, you know what that sounds like to me? Addressable market is still large. They can add locations. But yeah, I would love a little bit of update there. Maybe we can do some anecdotal evidence segments where you maybe describe it's Monterey, right? That you're in?
No, that's the biggest city in the center of the country by Texas. It's in Mazatlan. Starts with an M.
Okay.
Yeah. Similar.
All right, but before we get to the topics for this week, I do want to mention our friends at Public. If you are serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured, US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that take them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. Paid for by Public Investing. Full disclosures in the podcast description. Before we move on, I also want to say Public is a pretty sweet tool, and I personally keep a high yield cash account there, and they have a great high yield cash savings rate, or APY. So if you have a high yield cash account anywhere, or maybe you just have money sit in your bank in no or low interest, check it out. It's worth checking out. I guess, where do we want to start, Brett?
Let's start data centers, AI, Capex. I think that's a fun one. I don't think we're going to be talking about the proposed offer from Elon Musk to Sam Altman. I think that was just a whole nonsense thing. But we are going to be talking about, and Ryan has some fantastic data for the listeners, after the Q4 earnings. Well, some of it wasn't Q4 for them, whatever. Q4 calendar year. We have all of the Capex guidance for the big four hyperscalers: Meta, Microsoft, Amazon, and Alphabet. And I think, given what analysts were expecting, this was even larger than what everyone thought. And it essentially makes the bet bigger and bigger and bigger. But that's a good enough tease. Ryan, what's the skinny here? What data do you have?
Yeah, you wrote an interesting article. I love the title. It says, "Can we talk about Capex?" Because I think everyone is kind of talking about it. It might be a little bit of a played topic, but it's worth spending some time on because it affects it affects the market broadly. It affects the indices in a huge way. And it's just, I mean, kind of fun. So let me give some, I guess, quotes. This is a quote from myself. So I'm quoting myself, but I wrote this earlier last week. I said, "This year, the hyperscalers," and I'm just including Amazon, Microsoft, Alphabet, and Meta. Meta does not offer a public cloud. All the cloud services are for its own business, which is just how large their business needs are. Those four businesses together spent a combined $228 billion on capital expenditures over in 2024. That is 55% more than they spent last year. If that sounds like a lot, then buckle up. During each company's quarterly conference calls, they all announce plans to significantly increase their capex next year. Combined, these companies now expect to spend more than $320 billion in total capex for 2025. Let's put some context on this number. Well, important caveat: Amazon's number, some of that capex is going to go to e-commerce, but the majority is going to AI and data center build out and cloud computing infrastructure. That's what they said on the call. But $320 billion, you mentioned this stat in your write-up. It's basically equal to the total capex for those companies from, I think, 2012 all the way through 2020. Is that correct?
Yes, something along those lines. Almost a full decade of spending is going to occur if this guidance happens within one single year. I think the chart you have will show it for the listeners. It encapsulates how aggressive this acceleration is, because when you look at this chart, you can see, and it makes sense. You have steady growth from cloud demand. So each year, as these businesses get larger and larger, they're steadily going to be spending more on capital expenditures. And there was a slight increase during COVID that you saw a little bit of a bullwhip effect, normalization. Some of that was Amazon's e-commerce stuff. And then we saw growth again. But the last few quarters have seen huge step changes in capital expenditures for these big four companies. And we're apparently going to see even more of an acceleration in 2025. I think the analogy I have is we're adding a lot of water to the boat, and we don't want it to capsize. We want to make sure there is enough AI demand. There's going to be spending. There's going to be productivity gains. There's going to be whatever, what have you, where we're actually going to get a good return on this investment. And when we get to my bubble watch, we have even more stuff that I think is just aggressive. Like, I don't want to say that it's, I don't know. How would I describe it? It's not like it's guaranteed that it's a bubble, but it's just adding more and more expectations for what the earnings are going to be.
Yeah, I think there's some natural uncertainty around the ROI here. There's probably a lot of like confusion around what actually all this spending is as well. So people might not know exactly what's being spent here. Some of that might be just expanding pure cloud computing infrastructure. So adding more data centers that their customers can then leverage. And that's been kind of the CapEx blueprint for, I'd say, probably the last, well, better part of a decade for Amazon and GCP as well as Azure. The I've got a quote that kind of stands out here from Amazon's CFO during the conference call. He says, "The way the AWS business works, the way the cash cycle works is that the faster we grow, the more CapEx we end up spending because we have to procure data center and hardware and chips and networking gear ahead of when we're able to monetize it. We don't procure it unless we see significant signals of demand." And so when AWS is expanding its CapEx, particularly in what we think is one of these once in a lifetime type of business opportunities like AI represents, I think it's actually quite a good sign, medium to long term, for the AWS business. Now, it For me, I think I might be more optimistic than some on this spending. I think a lot of people, especially a lot of the traditional type value investors, where these have been capital like compounders for as long as I can remember, kind of look at this and just think it's malinvestment. Like they're almost certain that there's going to be this oversupply. But forget forget LLMs for a second. Forget conversational AI, which does require a lot of compute. And so that is probably certainly helping the cloud businesses right now. If we just think about AI in terms of solving mundane tasks in the workplace, whether that's like data retrieval, customer support queries, standard email response templates, like there is, I think that's what they mean when they say like AI agents, is basically AI being applied across mundane tasks in the workplace. There is tons of room for that to grow over the next 10 years. And I would be very surprised if any business of relevance in 10 years does not have some level of this in their business, or at least more than they're currently using. So I do think, and obviously they're seeing signals of demand to increase the capex. Now, all the LLM, all the conversational AI investments, those are maybe a little more concerning. And I guess the part that probably causes concern for a lot of investors is that they don't know what percentage is dedicated to just helping customers expand their data center needs versus like the company's own LLM and conversational AI type initiatives. My thing here is that remember what happened last time Amazon ramped CapEx? This was 2020. There was a whole bunch of concern. Now, more of this at the time was dedicated to e-commerce, but they ramped CapEx for AWS as well.
And they overbuilt. They closed a bunch of warehouses business? On the e-commerce. Yeah, they overbuilt.
Yeah. On the e-commerce side, they overbuilt. But they ramped CapEx for AWS for data center infrastructure as well during that time period. Now, that was COVID, so it was kind of this spur in demand. And there was actually a dip in demand following COVID. If everyone remembers, everyone was paranoid that AWS growth rates dropped to like 13% year over year and that the cloud was saturated. They have since recovered, and they built that in anticipation of more demand, and they got it. I just think they have a pretty good finger on the pulse when it comes to what data center demand is going to look like in a few years. And yes, of course, there is the risk of overbuilding, but I would think this is probably a good sign for future growth for those cloud divisions.
Yeah, at least for the next few quarters, but this smells like a bubble. Doesn't mean it's a bubble. It smells like it, though. It has all of the characteristics of a bubble. If anyone tells you, anyone saying they know what demand is going to be is not being honest. There might be a probability, but $300 billion, let's say chop up 20 billion for e-commerce, $300 billion. You know, these people know that the demand is going to be there, that the revenue is going to show up, that there's going to be adequate returns. I mean, people were quoting stats left and right during the internet bubble about how growth is whatever, blah, 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 blah. And they would say things about the telecom infrastructure, whatever, the pipes, the Cisco stuff, the fiber, the cables, all that stuff that just had, again, a classic bubble trajectory where they overbuilt for 10 years plus in demand. They essentially said we're seeing so many signs, the whole time they're saying we're seeing so many signs of demand increasing. There's no signs of slowing down. We're just going to build. And if you have that mentality, whether it's in 2025, I mean, eventually it's going to matter. Eventually you will overbuild. Now, maybe it's not this year, but if you start increasing CapEx at this rate, again, there's only so much capital in the world. There's only so much out there that you can utilize, right? Eventually the number is so big that it has to be.
Yeah, I get that.
By that logic, we should just spend $2 trillion.
no, I mean, I don't think they're just throwing like, I don't think they're picking this number just for like competitive purposes. Like, I imagine this CapEx figure they came to this figure because project after project after project, they realized it within the complex overarching subsidiaries that Amazon, Microsoft, all these businesses are, every one of them probably said, we need more capacity. And I get that, yes, demand can change. But I just think if you look out to 2030, which sounds a long ways away, but that's saying 5 years out.
You sound like a telecom analyst in 2001.
I mean, yeah, but it's not.
I guess the companies will be fine. Yes. These are well-capitalized businesses.
There was more telecom needs in 2006 than there was in 2000, right?
Yeah, but they had
businesses were levered purely to telecom. Amazon,
yes, exactly.
If they build out, they're not going to die. Same with Google, right? I mean, let's say it's a total waste of money. Okay, Google will probably do more than $200 billion in earnings in 2030, maybe in the 2030s at some point. The $60 billion they spend next year, is it going to make or break the thesis? Probably not. Now, the telecom companies and .com, yeah, that was their core business. But I just think, like, 2030, will there be more or less need for cloud computing? Will more or less workloads be run on cloud? Now, that doesn't mean there's great ROI in all the spending today, but it's just, I think that Bezos quote that you mentioned was like so ahead of its time. And I actually went back because I didn't even realize. I went back and tried to find the quote, and I read the interview with Wired Magazine, and it was like, first of all, the question.
What year was it?
2008.
I don't even remember.
Yeah. 2008. And the question was condescending. It was like, how much money are you willing to lose on AWS? And Bezos.
Hey, it lost money for a long time.
Yeah, well, it did. And Bezos said, like, look, we're fortunate to be able to think long term here, and we are quite optimistic about this business in the long run. And I mean, yes, obviously that was 17 years ago. A lot of that demand has probably been fulfilled, but I just wonder if we're like, it feels like we're in inning 7 of cloud computing. Everything's shifted over. I wonder if it's a lot earlier.
Maybe, yeah, over the long term, I clearly agree. It doesn't mean the stock, like, we're not talking about that. We're talking about whether the stocks are going to work.
I think, well, maybe not. Amazon, Google, I'm quite confident those stocks will work.
Even if this is a giant bubble today?
Yeah.
But then the earnings are going to deteriorate because you depreciate all these assets against no earnings or against no revenue.
Okay.
So the margins are going to collapse.
Look at Google. Yeah, temporarily. Is Google search going to be a worse business? Like, is it going to make less money in 10 years?
I guess,
because they depreciated servers for 2 years or whatever? Like, no.
5 or 6, but
it's 100. What did they have? $120 billion in operating income this year. They spend, what are they expecting? Google, I think, is at like expecting like 60 or something like that. It's just, they're not going to do it forever if the demand disappears.
Yeah, but then the stocks will come down.
It'll hurt the forward returns a bit for sure.
But I think people are forgetting in 2021, there was all this talk about how the semiconductor cycle was over. They're like, we're seeing infinite demand. We can't even bring any supply online. And that immediately marked the top. And then we went through one of the sharpest downturns in the semiconductor sector's history in 2022 that still hasn't recovered. And the only reason these companies are doing well, and some of them aren't even doing that well, is because of this AI boom. So when people have, let's just say I don't know what's going to happen, but it smells exactly like a cyclical industry, and how how the management teams are talking, or how all the other cyclical industries that go through a huge super cycle do. And eventually you spend too much money. Again, I agree
it's a
with you.
GPU
2030.
bubble.
What?
So it's a GPU bubble. 2020
I
was a
don't know what
CPU bubble. This is a GPU bubble. Like, I guess what I'm.
No, I'm just saying it's a separate industry. I'm just saying the same commentary from all the executives, you could just repurpose it for this sector. They're like, we can't even find a way that demand's going to slow down. It marked the exact top. Where all these analysts that were saying, are semiconductors not cyclical anymore? Mark the exact top.
True. Yeah, I do think the quotes around demand is unlimited. I think directionally, demand will be higher. I've already said that. It could certainly slow down quickly. I am curious, like, these GPUs that are used for a lot of the AI compute within a lot of the data centers, which makes up the vast majority of NVIDIA's revenue, is these big hyperscaler orders. Those are, I believe, it was the Sean Wang quote of the fastest depreciating asset in human history because of the development that's going on there.
Doesn't sound great for profits. I gotta say.
That is the one difference where I would say, like, look, if you overbuild on the e-commerce side, like Amazon did in 2020, and ultimately it didn't really matter that much. Look, you probably own a lot of the physical assets. You can get some value out of it. There's like
warehouse lasts for 30 years. Yeah.
Yeah, it doesn't depreciate as quickly. Whereas when one of the biggest expenses with the data centers is the quickest depreciating asset in history, and you literally are depreciating it over like a 5 to 6 year life, I think it's I do think there's some risk of quickly deteriorating margins.
Let me give you a good poll, and I don't know if we can just do, we never won't, whenever we have a a competition or some sort of bet, we never actually do it for anything, but it's more for the podcast. So they're guiding for $320 billion this year. Do you think that number will be higher or lower in 2027? Will the big four spend more than $320 billion in capital expenditures in 2027?
So that's 2 years out.
Yeah, I'm going to take the under.
I'll take the under. Well, I think part of it is too, like, if they build it now, they might not have to build as much in a year.
But I thought these depreciated immediately.
Yeah, but I mean, they've gone through this cycle before. Like, if you look at that Capex chart that we share, there was like a plateau period after 2020. Part of that was caused by Amazon's e-commerce stuff. But all right, I think we've kind of maybe gone too long on the discussion.
No, that was good.
Huge numbers. Good. And I mean, should people care? I would think yes. Like, this is going to dictate some of the returns that the average index holder gets over the next 3 or 4 years. Probably a good chunk of it, really, is basically where does this demand go? I have a lot of topics I want to get to today. One that was flagged for us, actually, is Match Group's new CEO put out a tweet this week. Brett, I want to get your thoughts here.
I did get tagged in this, yeah.
Yeah, thank you for tagging us for this, because I did not see it. I'm sorry if I'm blanking on the name, but someone tagged us. I really appreciate that. Spencer Raskoff, the new CEO of Match Group, said, he tweeted out, putting my money where my mouth is, bought $2 million worth of Match Group stock in the open market in my first week on the job. Average price, $34.40. We have lots of hard work in front of us, but I am excited about our potential.
I mean,
bragging about the average price. Yeah, I bought that 2 years ago. It's gone nowhere.
Yeah. I think that's a good thing. It's fine. This isn't bad. It's good.
I think it's a bit of a red flag, to be honest. Why can't you just... Why do you need to tweet it?
Why do you need to tweet it? Yeah, I think he understands that in the narrative in the investment community around Match Group is so bad. And I think it's not a terrible thing to try to change the narrative a bit. Now, you're buying $2 million worth. I'm curious what his net worth is and how material this is. And you have a note here, I'm just going to read it off here, that he has $29 million of Palantir stock because he's on the board of directors. I don't know if that's locked up, but I would be much more enthused if he sold a bunch of that and said, look, I'm probably going to have to leave this board. My time is fully dedicated to Match Group, and I bought $20 million worth, basically with most of the proceeds here. That would be more, I'd say, attractive. This is kind of a neutral to me. I don't know. Some guy tagged it to me that it was a red flag. I don't find it as that big of a red flag. I think it's good to have executives with skin in the game, but it doesn't guarantee that they're going to do well.
I like executives with skin in the game that have skin in the game because they believe the business will perform well in the future, which means you don't need to pump your books. Like, he could have just bought this, and if he saw material improvement in the business, guess what? He'll be rewarded. Does he?
Yeah, the Form 4 has to be filed. Yeah, so
like
people are going to find it. We're going to know about it.
This feels to me like pumping, kind of trying to pump the stock, trying to reinvigorate investors. And it's like, you know what? Reinvigorate investors if Tinder users stop declining for like a year. That would
that's fair.
The user base. But whatever. I guess
it's not that bad, but yes, he could have done better.
Not buying any, I guess.
Hey, at least they just didn't gift him a bunch of RSUs. This is better than that.
True. Okay. There's some other stuff I want to talk about here. Where do we want to begin? We've got a lot of earnings from this week. You've got Philip Morris earnings. That's kind of an interesting place to start. Why don't we go there?
Yeah, let's go there. I should say a company that both of us own. I think probably the best performer in each of our portfolios of the last 6 months, give or take. And it was another solid quarter. Really nothing to complain about whatsoever. Yeah, you get foreign exchange and stuff like that can toss things in there. They put out a chart. I don't have it in here, but their smoke-free business, which is essentially everything that's not cigarettes or cigars, has close to $15 billion in revenue in 2024 and is growing at a double-digit rate. I think that shows. And when we say, and I think I can't remember when we did the episode on Philip Morris. It's been a while now. But we highlighted in that episode, part of our thesis is we think compared to all of the other tobacco businesses, they have the chance to put up probably $10 billion in earnings from the smoke-free business, which is not in terminal decline, over, let's say, within the next few years. Probably not at least 3 years from now, depending on the growth rates, but maybe within 5 years, they can hit that figure. And that's huge compared to what their market cap is. And yeah, it's a lot more elevated today. I don't have the number in front of me, but for when you could buy the stock at about 10 to 13 times trailing EV to EBIT when the earnings were suppressed. Yeah, I like that. And then if you look at their cigarette volumes, in 2024, it was flat. It was actually up like 0.5%. Compare that to Altria Group, compared to that to the other ones that have much more exposure to the United States, and they're seeing huge declines. And yeah, they're making it up with it in price hikes, but Philip Morris can also increase the revenue through price hikes. So I think they just have a lot of good things going for them there. And if you look at the oral business, which is like the Zyn nicotine pouches and some of the other legacy stuff, along with the IQOS heated tobacco units, they're both growing volumes in the double digits, or at least revenue in the double digits. And Zyn in the United States is still holding market share, even with a supply shortage out there. And that's likely to alleviate sometime in 2025, which would see another boost to revenue growth. The stock has soared. As we're recording here, I think it broke through $150 for the first time. The EV to EBIT is now about 20. I think it's in between 19 and 20 on a trailing basis. I know, obviously, we like talking about this one because it's done well for us. Hopefully, anyone that listened to our episode and agreed with it did well as well. But Do you think it's still a buy here?
A buy, no, but I'm definitely not selling.
Yeah.
The quarter was good. It seems like they have a lot of momentum pretty much around all elements of the business. And the other part here is EBIT the margins should expand next year because they did go partly through sort of that IQOS investment cycle. So there's going to
Right.
be trailing EBIT is a little understated than what forward EBIT should look like. I would expect the forward EBIT multiple is very different, or at least a little bit lower. So I think 19 times trailing, probably I'm guessing 15
Seems
to
fair.
16 times forward. I think that's a very fair price for a business that I believe can generate double-digit per share earnings growth for 10 plus years. So yeah, I'm very comfortable holding at this price. I probably want to buy. Part of that's because it's just my largest position. I don't really want to. But yeah, I think it's still attractive. I think the returns from here are better than what you will get with the index.
Yeah, I agree. All right, we had a comment here that my mic was a little bit louder than Ryan's. Not sure what's going on with the settings. Maybe the settings changed, but I turned it down a bit. I'm going to move it back. All right, and hopefully we'll normalize that for the podcast and post-production. But I agree with all you said there, and maybe you can turn yours up a bit. I think that should help. Yeah.
Yeah.
If I told you I had a company, you know how they do those case studies, and I just said company A, company B. Company A is trading at 16 times forward earnings, 19 times trailing earnings, and you think you can grow earnings per share, let's say depending on the buyback program, earnings per share plus dividends at 15% for the next 5 years, at a 15% annual rate for the next 5 years. I might consider that a buy. I'm not going to,
Yeah.
right?
If you swapped the name, like if you put, let me just describe the financial profile for you. Yeah. Everything Brett just said, 16 times forward earnings. We expect 15% per share earnings growth over the next 10 years. And I told you it's meta because I bet the financials would look fairly similar, although the earnings multiple is probably higher. If I told you that's Meta, would you think that's a buy? If I told you that's Google, would you think that's a buy? I think people kind of get the ick from Philip Morris for ethical reasons, and that's fair. You know, everyone's got their own reasons to do things, but yeah, I think financially it looks sound. And unless anything happens to their new divisions that are so far seem to be bulletproof, I think they're in fine shape. Let's shift gears though. Before we move on, I want to mention Blue Chippers. They are one of our sponsors here on Chit Chat Stocks. Blue Chippers Club was recently started by two friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this community, everyone gets to share and break down their portfolios, pitch stocks, receive feedback, and participate in weekly calls. I've noticed that a number of people that listen to the show have signed up for Blue Chippers Club. Highly recommend, if you're interested at all, go ahead and check it out. It's a great community, and it's totally free to join. So if you head on over to bluechippersclub.com, you can hit apply. Like I said, totally free to join. The link will be in the show notes. And then one more time, I want to mention our other sponsor here, Public. If you're serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. Paid for by Public Investing. Full disclosures in the podcast description.
We got a comment here, Ryan. Yes. Oh, also, thank you to the Blue Chippers people. Really nice to see people joining that because they're listeners of the show. I'll try to get on there and post more. I haven't been building the habit very well, but I want to post some of our write-ups, some of the same stuff we do on Substack and stuff like that, and get a better discussion going on, for example, the OMAB Mexican airport Thesis. We had a comment here, though, Ryan. Someone said Pat Gelsinger bought a lot of Intel stock a few years ago. ... That is true. Doesn't necessarily mean the stock's going to be a buy. Then we had someone, this is going to lead to the topic I want to get to next, which is why you are buying Alphabet. They said, hi, Brett and Ryan. Meta has gone up 18 days in a row, including today. What do you think about the upside from here? Thanks. And it says, it looks like Meta is the only true one making money through AI, unlike other cloud providers. But at the same time, I guess incremental algo breakthrough on advertising from here should diminish, which is basically optimizing the advertisements. You can't spend an infinite amount of money there. I don't like PE, but forward PE is at 28. Yeah, it's not dirt cheap. That's for sure. But I think this leads into why Ryan, I think maybe you believe Alphabet is getting misunderstood at the moment, and why at, 17 times earnings? It might be the best Mag 7 opportunity right now.
Yeah, if I had to pick one of the Magnificent Seven to own, it'd be Google. Meta, I don't think you can necessarily, I don't think there's any issue in holding Meta here. I also probably need to do a little deeper work on it, but I mean, the growth rates over the last couple of years came slightly off of a trough. So if you actually go out and zoom out 10 years, Brett, maybe you can do this with our friends at FinChat. Go to Facebook's or Meta's EBIT and zoom out. The growth rate since like 2020, 2019 is okay. It looks really good over the last couple of years because there's been this reacceleration in advertising, in my personal opinion. So there's,
and the margins, right? Margin expansion.
Also the efficiency. Like there's been a ton of margin expansion as well, but it's either EBIT or revenue, either one. Maybe if you pull up both those numbers, it looks good, but I think there is maybe a little more top line growth risk with Meta than you get with some of the other businesses. So, okay, you've got operating income here. Still, I mean,
it's 2021, not 2020. But yes, same idea still applies.
Yeah. So if you pinch that timeline in from just 2021 to 2024, the growth rate's been solid. I imagine it's probably been like 13% CAGR. That's not the numbers you probably think of when you look at the growth rate over the last few years. So I think there's been sort of this reacceleration. There is the risk that advertising slows down when an economy slows down. There is some cyclicality there. So you kind of got to be expecting, I think, 15% earnings growth for this business to warrant 28 times. And even then, you're probably getting an okay return. I wouldn't expect great returns. So if you're comfortable with that bet, 28 times, no issue holding it. I don't know if I'd necessarily be a buyer here.
Yeah, I agree. It seems like the returns will be fine going forward, but does not come without risk. And I disagree. And this can lead into your Google thesis here that you're going to talk about. Just it's kind of an elevator pitch. I think despite how maybe bearish I sounded on the potential of spending $300 billion on capital expenditures, I think the cloud is a much more durable growth driver than anything Meta has internally. And that can be a huge, especially with the margin expansion, a huge earnings per share driver for Alphabet over the next 5 years.
Yeah, they're definitely the AI investments, quote unquote, from Meta. That's very broad, so it's a little hard to encapsulate everything that's in there. But yes, they've probably generated solid results for them, especially with the advertising efficiencies. But I mean, you've gotten good if you are building an AI powered type platform today, like if you're a developer, you want to use detection models to pull certain things from across different sites or whatever. Like if you're using AI throughout your business, somewhere in there, you're probably using Google Cloud or AWS, probably Azure as well. So the cloud providers have been big beneficiaries from AI. That's very clear. Just look at look at the cloud provider growth rates since this AI sort of hype cycle, if we want to call it that, has started, and they've very much reaccelerated. So they're big beneficiaries there too. Yeah, I guess elevator pitch. I'm buying Google. Well, I should say I bought some shares of Google. It's still a pretty small position after the last earnings. I don't think it's very complex. Like we can talk about Capex all day, but I think Google is one of, if not the best business in the world, best digital business, one of the widest digital moats. I think it can grow earnings per share of more than 10% per year for a long time. It can grow faster if the multiple continues to contract, because they do have some buybacks as a part of their capital allocation philosophy. And it trades at a forward EV to EBIT multiple of 17 times. I don't think that's very demanding.
Got a nice buyback.
There are things I hate about Google. For one, the Super Bowl ad they ran was one of the dumbest things I've ever seen. Did you see this, Brett?
I didn't. We didn't get the opportunity to watch Super Bowl ads down here because I guess foreign country, what have you. But I guess I was disappointed because I like looking at my Super Bowl advertising indicator. Remember the Temu one a few years ago, or the FTX and other crypto ones a few years ago. I'm curious, maybe we can talk about this after this, how your Super Bowl advertisement indicator or monitor happened. But this Google one, unexpectedly, I think like 80 to 90% of their commercials is it hurts them more than it helps them.
Yeah, this was actually almost so bad that it probably caught people's attention how pointless it was, and then maybe started creating some talk around it. At the end of this commercial, my brother, who has like pretty little interest in finance and doesn't care about the Google thesis at all, looked at me like, what was the point of that? And it was just some guy, to paint a picture, it was some guy talking into his Google Pixel, describing like his career experience. And then it turns into this like sentimental family thing. And then it's like, Google Pixel has AI. And it's just totally arbitrary. Like AI had nothing to do with it. It was pointless.
It's a nice family moment, and this AI tool can be there with you. It's not going to change anything about the moment, but it will be there listening. Would you like that? Would you like that, guys? Yeah, buy our phone.
Yeah.
Anyway, yeah, their marketing
I'm buying
team.
Google.
Yeah.
I think part of the issue when you get to be a business of that size is your marketing you have to try as hard as you can to not piss off anybody. And by doing that, you create the blandest commercials possible that like target no one. It targets everyone, but also targets no one. And
well, these might not be
their MO.
Yeah, I don't know what's worse, this one or the new Apple Genmoji ones. I think both. Apple's marketing has lost its allure. Think about didn't they do the Super Bowl ad with that 1984 one? They're smashing the window. And that was smart, good. It was fantastic advertisement. Now it's just music's playing and we have Genmoji. Great.
Yeah. Do we want to do Brett's Bubble Watch?
Sure. Yes. I think this will be fun. I think this is where you'll probably agree with me that there is precarious spending not backed by a fortress balance sheet like you have at Amazon, Meta, Alphabet, and Microsoft. So this one is a bit more serious. I know sometimes I bring in some jokes on this one. My second one, which we can just talk about briefly, is more of a sign of the crypto nonsense that we've been going through. But we've heard not the commitments, the announcement from SoftBank with Masa Son, Sam Altman, Larry Ellison, and President Trump at the White House, I think a couple of weeks ago. It's kind of hard to tell at this point. Yeah, here it is in the quote in the article about the Project Stargate, the $500 billion data commitment. We got some updates given their earnings or some sort of presentation that SoftBank did on how they're going to finance this. Here's a quote from the article. I think it was in the Japan Times. A few weeks ago, SoftBank Group founder Masa Son stood alongside U.S. President Donald Trump to unveil the Stargate project, an artificial intelligence venture with OpenAI that could cost $500 billion or more. Now, Son is figuring out how to pay for it. Might want to do that first, but we know he talks first, acts second, figures it out later. Here's the second part of the quote. SoftBank is exploring ways to incorporate some aspects of that funding structure in Stargate, which would span multiple data centers and power generation projects, said the people, blah, blah, blah. One scenario under discussion would have SoftBank, OpenAI, and partners Oracle and Abu Dhabi's MGX contribute in equity about 10% of the overall cost and tap debt markets for much of the rest, said two of the people. Only 10% of this is going to be equity, 90% of it is going to be debt. This, to me, reminds me of the telecom bubble. Because if you're... you need the demand to show up or else this thing would just completely collapse.
Yeah, absolutely. This is kind of mind-blowing. Committing $500 billion to anything as like kind of a sign of wealth and then borrowing it all is an interesting strategy, because I guess it's not really yours, but it is. I'll tell you what, Masa-san has some confidence, I should say.
Because apparently, according to Tyler in the comments here, he said, did you guys see the quote that Masa-san said Bill Gates and Mark Zuckerberg are one-trick ponies while he's building an empire? I don't know if I would call either of those guys one-trick ponies, but he is confident. That's for sure.
I mean, yeah, technically their businesses are maybe a little more concentrated with great, wonderful products that benefit society. But does that make... I mean, it's not his money. Is any asset manager building more of an empire than Bill Gates and Zuckerberg? Like, if you have investors and you invest in a lot of different things, does that mean you have more of an empire? Anyway, but SoftBank, honestly, it's on one of those things that I just don't dedicate a lot of time to care about. Like,
well, you might, Ryan, talking about Capex spending, talking about your 2027 prediction, talking about the cloud providers' demand showing up. If they spend $500 billion, that's competition.
Yeah, that's fair.
I don't think it's actually going to happen, though.
Yeah, I agree. How about this other bubble watch?
Yeah, this one's very important, especially for the people interested in keeping up with the meme coins like Brettcoin, which I should say, full disclosure, I never bought. I was saying it as a complete joke. I just found my friend told me there's one called that just because it was my name, and the price, not so great, down about 60% in the last month. But we have another meme coin here called Jail Stool. Let me just read the quote here. I think half of the listeners are going to have no idea what these words even mean, but I'm just going to read it to you and think about just the vibes and the mentality and the animal spirits out there at the moment and how that should maybe determine how to build your portfolio and whether to have a bunch of leverage. Okay, here's the quote. Jail Stool, a meme coin created in reference to meme coin traders calling for Barstool founder and president Dave Portnoy to be jailed for pumping another meme coin. You got that so far? Has skyrocketed over the weekend after Portnoy got behind the coin and promoted it to his social media followers. The mania, however, has died down somewhat, with the coin trading lower since surging to all-time highs on Sunday. Shocking, like every other meme coin out there, it rockets higher, people sell, and then it goes steadily to zero.
The golden age of fraud still applies.
That's a good reference. Yeah. Yes.
I think we talked about this. It's been easy to talk about for months now, but if you have some fame, there has never been an easier time to monetize that than, shilling a meme coin. What is your reputation worth in this case? And in the case of Haktua coin, it doesn't, you can get paid a lot. And it doesn't surprise me that some people choose this route. It is a ton of money that they can make.
Yeah,
Bummer,
it's
I guess.
unethical. No, I
I
think,
agree.
yeah, it is unethical. Well, we can get to another serious topic, which would be your small cap of the week. But speaking on the chips, we had a good comment here. Any thoughts on potential tariffs on chips from Taiwan? I think generally our number one rule is to try to invest in stuff that's not going to be impacted too much by tariffs or can either weather the storm. I remember back in the day, I was excited because I was an idiot back then. Oh, iRobot, this is a great company, blah, blah, blah. And then one tariff hits and the business just collapses. You want a more robust business than that. But the second rule I think I have is given the chaos that it seems like there's an announcement, pullback, we're changing the rules, we're making this whole new thing. It seems like there's 10 new things announced every day and you can't keep up. My rule of thumb is that if the incentive is like against what logic would be for fighting inflation or keeping the United States economy strong, regardless of if manufacturing actually comes back to the United States, you should say that they're not going to do that. That's why the Mexican tariffs aren't happening yet, and I doubt will happen. With this one, I also doubt the same thing. Are you going to kill the AI boom that's contributing a ton to growth and is a huge race versus other countries like China? I doubt that's going to actually happen.
Yeah, there's a lot of the political stuff. It's been in the news nonstop for the last couple of weeks since Trump took office, but a lot of it's more noise than news. And a big reason for that is as soon as it affects the indexes, as soon as it affects people's 401ks and the stock market, which Trump does like to measure himself by,
It's another good rule. Yeah.
if it affects it, you can expect that the rule probably will not be implemented. There
Or at
might be
least
some
not for very
exceptions.
long.
Yeah.
Yeah. Yeah, exactly. All right. We got to get to the small cap of the week. I think this is the listener's favorite segment, so we don't want to miss it ever. Ryan, what do you got? And what's the company?
Yeah, this was a listener recommendation. The company is Crocs. Now, I'm cheating here because it's a $5 billion market cap, so more like mid cap of the week instead of small cap of the week, but still.
Soon to be small cap. That's how, isn't that what we should call it?
Yeah, future small cap of the week, maybe.
Future small cap. Yeah.
So a little bit of background on Crocs. I imagine if you're in the US, you probably know the business fairly well. The company was founded in 2002 and there apparently it was like very successful from the jump. Within 2 years of launch, it broke $100 million in sales. For anyone that doesn't know, they sell like basically plastic sandals. Is that how you would describe them to someone who's never seen them? Plastic sandals.
Plastic sandals with holes in them, and you can buy decorations. It's mainly for kids, but some adults wear them.
True. Now the revenue chart is actually quite wild. So from 2004, Brett, maybe you can pull this up. This is using our friends at FinChat. I should mention if you want a unlimited data on all stocks around the globe, FinChat's got you covered. You can use our code finchat.io/chitchat to get 15% off. But yeah, looking at the revenue from 2004 to 2024, it's gone from $14 million to $4 billion. So 33% annual growth rate over 20 years. Now, there's some nuance here. They got up to 850 million in sales by 2007. And then for about a decade, didn't really grow at all. Like from 2007 to 2018, they went from 847 million in sales to 1.1 billion, basically, in sales. So negligible growth. But then I guess from 2019 to 2024, they went from a billion in sales to 4 billion in sales. There was an acquisition during that point too, but apparently when people got stuck at home, they bought a whole bunch of Crocs. So there's more to the story. In 2021, Crocs, revenue was taking off. They bought Hey Dude for $2.5 billion.
$2.5 billion? Oh.
Yeah. Hey Dude was growing really quickly. I think it was around 500 million in sales, like growing triple digits year over year. However, it's another shoe company. It's like kind of like Vans, kind of looks like Vans, I guess. Sales have turned around. Now sales are starting to decelerate. They peaked in Q2 Q3, I guess, Q4 2022, they were doing 280 million in quarterly revenue. Now it's down to 200 million. So
They spent $2.5 billion on a shoe company that does 200 million. Okay, at the time, 270 million in quarterly revenue.
yeah,
That's ridiculously bad.
now
That's terrible.
here's the thing. It's also extra bad when you put the context that they were supposed to give them a distribution advantage. Like Crocs has all these inroads with wholesale partners. So you should be supercharging revenue growth once you're under the Crocs corporate umbrella, and revenue is literally declining now, which shoes are not super profitable. Crocs probably are. They certainly are. I think they've had 20% operating margins. And if you just think about the cost to build a plastic clog, it's not very high. So
yeah, good margins, 25% right now.
Yeah, they're very profitable. I found a good quote from a Substack. It says, and this guy's pretty optimistic on it. He says, I think Crocs has a core franchise which stays stable in North America, grows steadily internationally, and continues to produce reliable cash flows. This cash flow funds international investments and occasional buybacks at sensible prices. Hey Dude is still an attractively priced option. It's profitable, but has returned to earth after rapid pre- and post-acquisition growth. The question now is whether management can right the ship and generate an acceptable return on the significant investments in the brand. Now, I'm not going to write off Crocs entirely. I do kind of have a no apparel policy with my portfolio, but
Never invest in apparel. I've said it a million times.
EV to EBIT is 6 times. Now, back at kind of 2 years ago, cash flow conversion was really good. Actually, more like 3 years ago. Cash flow conversion was really good, so the EV to free cash flow was very similar. Capex has now ramped. I'm not sure what exactly the Capex is all being invested in, so the EV to free cash flow is 12 times. Here are the things that, for my research going forward, if I'm going to be interested. Number one, I have to figure out, is Crocs' recent success a byproduct of something changing at the business? Like, have they unlocked maybe a really good marketing algorithm? Is there some sort of like more customer loyalty, or are we at risk of going through another 2007 to 2018 period where they basically have flat revenues for a decade? Which honestly, if it's flat revenues for a decade, the valuation could still work, assuming that they improve cash flow conversion. Second one I want to find out is Hey Dude completely dead? If it is completely dead, that's okay. Like, you can still work on the valuation. At the current valuation, it can still work here, but as long as they don't just hemorrhage cash and keep investing in that business. So if you can figure out that cash flow is going to remain steady or at least grow in aggregate over the next 5 years, I think this can work, assuming that they don't make another acquisition like they did with Hey Dude and instead redeploy it into buyback. So I find it interesting, but I think there are easier investments to make today.
Yeah, I don't like it. I think it's another example. Don't invest in apparel. What do I know what this company is going to have demand for in 2030? I have no clue. I have no clue. I'd rather buy American Express at 23 times earnings. I'm serious.
Their success, I think it is entirely unpredictable. Yeah. Like, them getting to $800 million in 5 years from launch of sales is like, it blew everyone's minds. And that's the whole point. It's unpredictable. You don't know what's going to resonate with consumers apparel wise. And you can say the same thing going the other way, right? Like, I know people love Crocs, but people loved Reeboks. People loved Under Armour. People loved a whole bunch of other apparel brands that are not popular anymore. I just think things can change quickly.
I agree. I just still don't like it. It probably could work. If you catch the bottom of the cycle and all that good stuff, yeah, it can work, but I don't know how to do that. All right, as we wrap things up here, Ryan, we want to talk Netflix getting into podcasting. I saw you liked my tweet about how Netflix, Spotify, and YouTube are all just trying to become like each other.
Yeah, this is kind of encroaching a bit on YouTube's territory, I think. Now, okay, yeah, basically they've been talking to popular podcast hosts about, bringing their podcasts to Netflix and making it sort of probably exclusive content, I would guess. Maybe not totally sure.
Sirius XM style, kind of.
Yeah. It's definitely cheaper than building out a show in terms of engagement. Like, you would certainly attract engagement at a lower cost.
I mean, Joe Rogan's way more popular than whatever blockbuster things and TV shows that Netflix is making.
Yeah, someone says future Chit Chat stocks Netflix series.
Yeah, are you looking for Are you looking for a mid-market investing podcast that gets hosted on Zoom every day? We can put that on the Netflix app. I think that will be great for your quality.
Hey, we're on Riverside. We've upgraded.
Yeah, I think honestly though, they're looking for probably just the biggest shows, and they're going to make them maybe exclusive or just licensed on there like they used to do for their other stuff. And it comes back to what they care about, and why I think that YouTube, Spotify, and Netflix eventually converge more and more and more over the next decades or years, maybe not decades, is because they have, at the end of the day, they only care about time spent, all three of these companies.
Yeah. I mean, I think it's a good idea from Netflix's perspective. They
That
have
makes sense.
very rarely, especially in recent history, been wrong on like pivoting content or adding content.
Just really gaming. Just gaming. That's probably it.
Yeah. I guess that was a bit of a miss. I think a lot of people watch, especially on YouTube, they watch podcasts on their TV. It's kind of a way to potentially eat some of the time spent on YouTube for connected TVs, if you're looking at it from Netflix's perspective. So, and it's not like it shouldn't be a huge cost for them, like it would, like live events would be potentially. So,
yeah, but here's where YouTube has the long-term advantage. YouTube never gets paid. Sorry. YouTube never pays these people. Netflix is going to have to pay them.
True. YouTube is a wonderful business.
And I think that the Netflix executives are looking at the Nielsen market share and how YouTube and Netflix used to be kind of neck and neck, just steadily taking market share for TV time spent in the United States. Now, and YouTube is growing much faster. I think that's what they're seeing here, and that's why they're acting like this. Unlike when they target other competitors, this is a defensive move. And it's the one area where they have a weakness, which is YouTube.
Yeah. I think that's going to do it. We've kind of gone a little long here. You want to take us out?
Yeah, let's do it. Thank you for everyone that joined us on the live stream. Apologies for the bad background, but I think the video, and at least besides that 1 minute there with the microphone going very loud, hopefully it wasn't too crazy. And for the recording, we will change that in post-production to normalize the audio. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan and I or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again, and we'll see you next week.